the Federal Reserve, maybe other central banks too, but this idea that they made things so liquid for so long, didn't raise rates. Now they're in a position where they don't have any firing power left, and they're going to have to raise rates as we look at an economic slowdown. In fact, that's almost the intent of what they're doing to try and deal with this. Would you rate the Fed as doing a good job? You look back, you see what happened and what they're doing right now?
I think what they're doing now, they should be raising rates. They should have started earlier. The thing is, there's one side that says the inflation came from too much demand, and that's the traditional Fed should just raise rates to reduce demand. But there's this whole supply side component that Mick mentioned, that if you think the inflation is at least partly coming from supply side, Fed raising interest rate is not going to pump oil. Fed raising interest rate is not going to make computer chips. And so there is a danger of stagflation. So the Fed has got to balance out some things that it doesn't normally need to balance out.
Rick, when you look at these moves that are taking place, you said you don't think modern monetary theory is going to come back for a long time to come. At least I think that was you. Maybe it was Mick. These are some pretty difficult lessons that we're going to have to learn. What would you equate it to? Because you've been watching the bond markets for a very long time.
Yeah, it's not only modern monetary theory. It was never a good idea. It was a stupid idea, and we're seeing living proof of that. You can't print forever and think you can get away with it. Look at what the pound's doing. But I think if there's a lesson to be learned here, it's the fact that central bankers in general and governments in particular have this unique relationship that we need to find a way to separate. And it isn't necessarily a political relationship. It's an enabling relationship. They are enablers. By these low interest rates and hanging out at zero for so long, they allowed governments to do anything. They allowed companies to remain that should have died. They ruined the entire infrastructure of global finance. And to think that it's going to come together easily, or if central banks have any plan, there is no way to put this Humpty Dumpty back together. There needs to be lots of financial destruction first, and from that, the Arizona will rise. The best fertilizer for the global economy right now is for all of these issues, whether it's foreign exchange, government debt, corporates, all of these financial instruments have to be pushed down to some level that represents true risk to value returns versus the pie in the sky valuations and returns that many were getting with virtually no risk.
All right. Austan, I want to come back to you and have you put on your economics hat and just talk this through for a minute. We are now talking about Goldman Sachs and other places saying that a hard landing is much more likely. What does a hard landing look like from the economic perspective? How would you lay that out, and what are the odds of a hard landing in your opinion?
Well, I think decently high. I always have my economic hat on, Becky, and I appreciate that. The thing is, the most common cause of recession in the United States, more than 2/3 of the recessions that we've ever had since we've been keeping the data, came from the Fed raising interest rates faster than the economy can handle. So when you're in an environment where the Fed is going to meeting after meeting raise 75 basis points or more, there's a decent chance that they overshoot and create a recession / hard landing rather than soft landing. And you know what that looks like. It looks like savage times for any part of the economy that's interest rate sensitive. So that's housing, autos, consumer durables, business investment. Those are going to be the first places where you see things go wrong.
And Mick Mulvaney, from an OMB perspective, what happens as interest rates rise? How much more difficult is this for us to finance our debt?
It becomes a vicious cycle, right? You end up borrowing more money to pay the interest bill. The interest bill this year, Becky, will exceed the amount of money we spend on the Department of Agriculture and Education, Interior, Commerce, Treasury put together. It's a huge sum of money. The real question is this, I think, is the Fed is doing what the Fed is doing, right? I blame the Fed for making bad decisions, as I think Austan does. I don't really blame them now for raising interest rates because it's really the only tool that they have. Where's the other tools that we could be bringing to bear here to make the situation better? Where is the discussion in this country for the last 6 months, 12 months about deregulating? Where is it? Where are we having discussions like the Germans, who are now burning coal? The British, who I said are going to explore fracking. The Japanese who are looking at going back to a nuclear policy. Where's the same discussion in this country? Let the Fed do what it does on demand destruction. It's all they know how to do. But where's the policy coming out of Washington, D.C. on the supply side to make it easier to make more things and bring prices down that way instead of having a hard landing and focusing just on demand destruction, which is where it looks like we're going right now?